Good morning, everyone. I'd like to thank everyone for joining us today. We have what most people may not consider the most exciting topic in the world, but certainly one that has received a lot of press over the last couple weeks as we have some new mortality tables that have been released. So we're excited that all of you could join us today, and I know just as many people said they couldn't make today because of a conflict, but we will have an audio recording of this presentation available in the next couple days up on our website at findleydavies.com. So if you're getting in here a minute or two late, you're still going to be able to go back and catch up on everything you missed. So to jump right into it, I am your presenter for today, Matt Klein, and my contact information. Please use the chat window if you have any questions throughout the presentation, and we will have someone monitoring that, and hopefully we'll have time at the end of the presentation to take a couple questions. With a half-hour format, we do try to condense a lot of material in a short amount of time, but we'll try to answer as many questions as we can. So you're attending today's session to learn about the new RP 2014 mortality tables released by the Society of Actuaries. My goal today is not to put everyone to sleep with in-depth discussions on double cubic methodology or any other such nonsense. The goal today really is to focus on the mortality assumption and what does that mean for plan sponsors and stakeholders involved with plan sponsors, so auditors, actuaries, human resource professionals, anyone else that has to deal with the pension plan and how that affects them. So just a little bit of background. The Society of Actuaries released an exposure draft in February of 2014. There was a lot of comments received to the Society as a result of that. The final table was issued on October 27th. None of the methodologies or any of the numbers used in the report changed, but what the final report did soften up in a couple areas some of the language that was being used as far as how much the Society was prescribing the use of these new tables. So we'll get into that a little bit. It is important to note that the discussion regarding whether to adopt these new mortality tables is, for the moment, really restricted to accounting liabilities for both pension and retiree medical plans. Because the mortality assumption for funding purposes is controlled by the IRS now, they have not formally adopted these new tables. So we're strictly talking about accounting purposes for here. We're not talking about minimum funding requirements, AFTAP certifications, lump sum calculations. All that stuff is expected to come down the road. We're hearing probably for implementation in 2017. So when the Society of Actuaries released this new table, you may not realize the Society actually released 11 tables. So they basically can be broken into two different columns, our annuitant and non-annuitant tables, labeled here as not in payment or in payment. So what most people will end up using, or probably any comparisons that you may have seen in other reports, probably was a comparison to the total non-disabled table. But there are other options from that general standard table. So there's a specific mortality table for blue-collar and white-collar populations. As research has shown that there are distinct differences in those populations. They also released a bottom quartile and top quartile depending on what your anticipation might be for future mortality trends, if you want to use that. And then finally, for the annuitants or in payment, there's also a new disabled mortality table, which we'll talk about in a little more depth momentarily. So what do these new tables really mean? So what we're seeing in the increase in life expectancy is for men that they are living 2 full years longer. So men age 65 this year, their life expectancy is increased from 84.6 up to 86.6. And women saw an increase in longevity of 2.4 years from 86.4 to 88.8. This was a little bit notable because what we had been seeing in previous tables was that men's life expectancy was catching up to women, but the most recent research has women pulling further ahead. The Society also released a new mortality projection, that's the MP in the MP 2014, a new projection scale that anticipates improvement in life expectancy. Now, with the RP 2000 table, for many years we had what was deemed projection scale AA. In the last couple of years, the Society came up with a new projection scale, which was called BB. And now with the new 2014 mortality table, we have this new projection scale that has been labeled MP 2014. And what this really does, this new table is really bringing what they call two-dimensional or 2D mortality improvement on a large scale where it's probably going to have widespread implementation. So in the past, projection scale has basically been one-dimensional. So 10 years from now, we would project the mortality table out 10 years. But now we also are considering not only the age currently, but the year of birth. And so the idea here is that we're going to reflect generational improvements in mortality. Mortality improvement has not been static and has not been uniform, and so the idea behind this more sophisticated projection is to try to capture some of those trends more accurately. So this improvement scale is kind of using historical data and it kind of converges into a long-term average. Now, for the projection scale, obviously, we're trying to predict what's going to happen into the future, and there can be many different valid opinions on that. On one side, you have people saying that, with all the improvements in medicine, that life expectancy should continue to increase and maybe even accelerate the pace at which it's improving. On the other hand, you'll have people, that say that, the obesity issue or some kind of, pandemic issue would cause cause those rates to not increase as quickly. So, just food for thought as you're having these discussions. So, if we take a look at it, what does this actually mean, this new table? So, I've provided several examples here, and so listed this the plan characteristics. What we've seen is as I mentioned, the mortality improvement for females has been greater than that for males. So we're seeing generally a bigger increase for our female populations. But the other aspect is, if you're going to this new table, is what mortality table were you using before? And depending on if you are using the most recent table, or if you're using a table that was getting somewhat dated, would affect the percentage increase that you're seeing here. So, if we're using the PPA mortality table, which is the one that's being mandated by the IRS currently, you're looking at somewhere between a 7 and 9% increase. If you're using, some other tables, you see varying degrees of improvement. I will point out on the last one here, the 9% increase for a heavily male population using a table that was already using the scaled BB methodology was it seemed a little bit high at first when I evaluated it, but when we dug into some of the details, we realized that, with that particular plan, we had a lot of disabled participants. And the change to the disability mortality really has not, is not something that makes the press clippings per se, but the increase on the disability mortality table is quite significant. What we're seeing is not only are we getting the natural progression and mortality improvement that you would expect, just as similarly to our healthy population, but there's been a change in the thinking that the disabled mortality table should also be projected, that we should be assuming mortality improvement for disabled participants as well. And so this is a change from prior, the way prior tables were released and the way actuaries were instructed how to use those tables. So we kind of have this double whammy effect of not only updating the mortality table, but now throwing a projection on top of it. So as you can see in the box on the bottom half of slide 9 here, the mortality or the increase in the annuity value for someone, for a male age 65 using that's disabled, their annuity value is going up 23% compared to the RP2000 disability table with no projection. So it's a very significant increase. And if you have a population that has a number of disabled participants, you can expect to be more on the higher end of the range of the increases as opposed to the lower end. It's also important, a lot of this presentation and a lot of media outlets, generically talk about pension plans, but there's definitely an impact here for retiree medical plans as well. If anything, for retiree medical plans, the increases could be even more significant if you're a plan sponsor that is still bearing all the inflation risk. What we're doing is we're adding a couple of years out. For someone age 65, we're adding a couple of years out, at age 87 and 88. So we've got, 23 years of inflation, of medical inflation to build on top of that. So the increases that we're looking at for retiree medical plans are probably, again, also would be on the higher end of, any estimates you may have seen. One of the other differences from the RP2000 table is the Society of Actuaries did not provide a combined healthy annuity table. If you're a plan sponsor that has less than 500 participants, you are able to use this simplified table that doesn't break out the annuity rates or the mortality rates into annuitants and non-annuitants. And that same combined table is also being used for 417(e)(3) purposes, which is the code section where the lump sum methodology is laid out if your plan offers a lump sum provision. So there is kind of this outstanding question that'll need to be answered by the IRS at some point, which is, what are they going to do for 417(e)(3) purposes, and will they have to come up with their own table, or will they try to somehow use a blend of the annuitant and non-annuitant tables to come up with an answer? So, that the fact that the society didn't automatically provide that table may, delay the implementation as well, which is why generally I think most actuaries expect that implementation to happen in 2017 and not 2016 due to the effort and getting out in front of that issue. So we've reached out to a number of our accounting friends, and we've received, inconsistent feedback, I guess would be one way to put it, from different accounting firms as far as what their feelings are as far as the implementation of these new mortality tables go into financial statements. We've heard from some auditors that they are going to be rather insistent, and that this new table represents the latest and greatest in mortality mortality assumptions, and that firms or plan sponsors should be moving to this rather quickly. Others have simply said they'll continue to use what they've use their prior practice, which is look for support of the plan sponsor's decisions and document that for their files. And sometimes we've even gotten these conflicting reports from the same accounting firm, just depending on which person you talk to. So I think there's still a lot of discussion being had as far as within the accounting community and the audit community, as far as the implementation of these tables. I will say that based on the feedback that we've had with other actuarial firms and other presentations, I don't think most actuaries are quite enamored with these tables. The Society of Actuaries received a lot of feedback during the comment period, questioning some of the different methodologies and the data sets being used in the actual results. Like I said, at the end of the day, the Society went ahead and published the tables as they did. In a couple places, they did soften the language a little bit, but for the most part, the Society reconfirmed the work that they had done and went ahead and pushed these reports and these new mortality rates out without any further adjustment. So it'll be again, that'll be one of the interesting things to see how this evolves as to whether how quickly and how widespread the adoption of these tables become. We have seen a couple informal polls, nothing that is comprehensive or you can really hang your hat on, but it appears from what we've done and what we've gathered that it's looking like less than 50% of plan sponsors intend to adopt the new tables. Now this was kind of a poll done of plan sponsors, so I don't know if if they've most likely they had not talked to their auditors or the actuaries to discuss the issue given the timing here, but it was just gives you a sense of what how enthusiastic at least the plan sponsor community is to adopt these new tables. We do have this issue where these low discount rates kind of compound things. Again, similarly to what I mentioned on retiree medical, we're extending the life expectancy, for someone by a couple extra years, and those couple extra years, occur, kind of on the tail, as we're kind of, looking far out. So as we're discounting these payments back, 20, 25 years, when we're doing that in a very low interest rate environment, the impact of those increases is even more significant. So, so the timing of this, I guess we could say is not ideal. So let's talk specifically about, and try to, have an engaged discussion as to whether we should be moving to these tables. And we're not here to advocate one way or the other, but simply provide everyone with some of the considerations to look at. So when the actual quote here on slide 14 is taken from the actual Society of Actuaries report, where we've underlined and highlighted a couple phrases here. I think there is, I don't know if it's somewhat of a myth, but there is the perception out there, it appears, that the Society of Actuaries was, mandating or requiring the adoption of these tables. And, when in fact, if you look at the actual language from the report, all the committee is doing is recommending consideration of their use, although they did, they did add the effective immediately. So, I think this is something, and certainly the audit community is on top of that part, that I think most plan sponsors are going to take a serious look at it, this year. But there's nothing in here that, requires the use or the adoption of these new tables. So that's from the Society of Actuaries report. And then there's also, they talk about the, the generational projection. I think that is going to be the kind of the new standard practice, is to adopt this generational aspect. But again, it's not a requirement that you use the scale MP 2014 for that mortality improvement. I think there's certainly room within the language here to use some alternate assumptions if you think that the recommendations by the society were a little too aggressive. And then from the actuary standpoint, of course, we have professional standards, and ASOP 35. The ASOP stands for Actuarial Standards of Practice. This was actually also updated here in 2014. So, when we have to look at our professional standards, we have to look at and make sure that the mortality assumption is something that is appropriate and reflects our professional judgment and reflects our expectation of future experience, and try to be, try to have an assumption that has, it says no significant bias, but try to have something with as little bias as possible. So, so from an actuarial standpoint, that's kind of, what we're looking at. So to kind of pull this all together here, what considerations do you really need to look at as to whether to adopt this table or not? Probably the most important thing is just understanding your own plan and what impact that may have. If you are a plan that offers lump sums right now, chances are you are reflecting that lump sum assumption in your as part of your cash flow and part of your liability determinations. And as I mentioned at the beginning, the lump sum mortality is not being affected, as that is controlled by the IRS. And so we will, we're not going to see that implementation for a couple of years. So the impact for plans that offer lump sums probably will not be as significant. Also, if you are a sponsor of a cash balance plan, remember, a cash balance plan looks and feels very much like a 401k plan, where we are not promising an annuity for life. What we're doing is accumulating an account balance. So, so the impact of the mortality assumption for a cash balance plan is much less significant because we're valuing an account balance as opposed to an annuity that's payable for life. You all want to, consider, your specific plan's population. Like I said, the new mortality table has a bigger impact for, bigger improvement for females than for males. We also have the introduction, well, not the introduction per se, but there's alternative mortality tables within that universe that the society released. So, if you have a union plan or something that's, very blue-collar workforce, you should seriously consider using the blue-collar table as opposed to the, just the total mortality table. The experience of the plan can also play a factor. The actuary should be able to look at fairly easily the last few years to see if you've been generating mortality gains or losses. Although it's important to note that, very few plans have a big enough population to truly be credible. So while you can use that as a consideration, you certainly can't, put all your eggs in that basket, and it needs to be considered in the broader scope of what's going on. The length of time since your last review, we've have a number of plan sponsors that moved to the scale BB with the projecting using that scale BB just as recently as last year. So there's already been some movement towards these new mortality to using more updated mortality rates. I think. So the question is, do we need to look at this, just a year later? Would the RP2000 with scale BB still be a pretty reasonable assumption? I think most people would say yes, but certainly not everyone. For some plans, the accounting assumption for mortality is to simply use the mortality table for funding purposes. If that's the case for you, you probably will make the switch when the IRS makes their switch, and at that point, you're just following along with the same methodology you've always used. You update your table when the IRS updates the funding table. So it also creates a question of, if you're not doing that right now, would the auditor allow you to move to the current funding mortality assumption? From that aspect, it does simplify things that you're using a consistent mortality basis across all of your liability determinations. There is one thing to be said, though. If you do move to these new tables and you go with will probably be the new standard of this generational mortality concept, is that you might have to, quote, bite the bullet right now, but you won't have to look at this assumption again for probably a decade. It took the Society of Actuaries went from 2000 to 2014 to do a new comprehensive table. So if we look at if we say it's another 14 years, with the generational aspect of this, that we're basically assuming a small mortality improvement each year as we're going along, we're not going to have to worry about this particular assumption for quite some time. So we've gone over a lot of material in a short amount of time, and I see we have just a couple minutes left. And if you have any questions, if we've had any questions, feel free to type them into the chat section, and we'll try to get to those. And I see we do have one question in, and that question basically is, what are we hearing from other consulting firms? And I think the answer to that is that, I think some of our competitors are, like I said, they're certainly not totally buying into these new mortality tables, especially the projection scale, and and so I know one of our competitors is looking at possibly doing mortality tables by industry or something to that effect. So when I said earlier that the actuaries were not enamored with the new tables, I think that was a fairly accurate statement. That there is certainly not complete buy-in from the actuarial community on these new tables, and so like I said, some of our competitors feel strongly enough that they may go and research their own tables if they're able to gather up enough lives to do their own independent analysis. We'll see if that actually happens or not, but that's what we're hearing. So I mean, look in, and I don't see any other questions here in the chat room, and we are at right at 10:30. So I will wrap this up. Thank you, everyone, for your attendance today. Again, we should have this available, both the auto recording and a copy of the PowerPoint presentation available on our website on Thursday the 11th. And if you have any questions about anything that was discussed during today's presentation, my contact information is currently on the screen, and I will look forward to those phone calls and those discussions. Thanks to everyone for your time, and we'll see you next time. Thank you.